Picture the US economy as a vast and complex machine, its gears grinding and churning, driven by the flow of money. At the heart of this machine lies a powerful lever: federal interest rates. These rates, set by the Federal Reserve, or the Fed, act as the economy's thermostat, regulating the speed at which money flows through the system. Just like adjusting a thermostat controls the temperature of a room, the Fed manipulates interest rates to influence economic activity. Lower interest rates make borrowing cheaper, encouraging businesses to invest and consumers to spend. Higher rates, conversely, make borrowing more expensive, cooling down an overheating economy. Understanding federal interest rates is akin to grasping the fundamental laws of physics. These rates influence everything from the price of a cup of coffee to the trajectory of the stock market. They are the invisible hand guiding our economic destiny. One key indicator of federal interest rates is the effective federal funds rate, often referred to as Fed funds. This rate represents the interest that banks charge each other for overnight loans, a critical component of the financial system's plumbing. Think of Fed funds as a patient's pulse. A steady pulse signifies a healthy circulatory system, while fluctuations can indicate underlying issues. Similarly, Fed funds offers valuable insights into the health of the US economy. Historically, Fed funds has fluctuated significantly, reflecting periods of economic boom and bust. For example, during the 2008 financial crisis, the Fed slashed interest rates to near zero to stimulate lending and prevent a complete economic meltdown. By analyzing trends in Fed funds, economists and policymakers gain a deeper understanding of the economy's trajectory and can make more informed decisions. In recent years, the US has faced a perfect storm of economic challenges: soaring inflation, supply chain disruptions, and geopolitical uncertainty. To combat these headwinds, the Fed has embarked on an aggressive campaign of interest rate hikes. While raising interest rates can help tame inflation by slowing down spending, it also presents a unique set of challenges. Businesses may postpone expansion plans, consumers may tighten their belts, and the stock market may experience volatility. The current environment of rising interest rates has sparked concerns about a potential recession. Economists closely monitor economic indicators, searching for signs of a slowdown. The Fed faces the delicate task of raising rates enough to curb inflation without tipping the economy into a recession. The impact of interest rate changes extends far beyond the walls of the Federal Reserve. When the Fed raises rates, the effects ripple throughout the economy, influencing the financial decisions of individuals and businesses alike. Loans, the lifeblood of many businesses and consumers, become more expensive as interest rates rise. This means higher monthly payments for car loans, student loans, and credit card debt. For businesses, higher borrowing costs can impact investment decisions and hiring plans. Mortgages, the loans that finance home ownership, are also sensitive to interest rate changes. As rates rise, mortgage rates tend to follow suit, making it more expensive to buy a home. This can price some potential home buyers out of the market, cooling down the housing sector. Section 5, a balancing act: interest rates and economic growth. The Federal Reserve's mandate is often described as a balancing act, promoting maximum employment while maintaining price stability. Interest rates play a crucial role in this delicate equilibrium. When the economy is sluggish, the Fed may lower interest rates to stimulate borrowing, investment, and spending. This injection of liquidity can boost economic growth and create jobs. However, if rates remain low for too long, inflation can rear its ugly head, eroding purchasing power and destabilizing the economy. Conversely, when inflation runs hot, the Fed may raise interest rates to cool down the economy. Higher borrowing costs can curb spending and investment, eventually bringing inflation under control. However, raising rates too aggressively risks stifling economic growth and potentially leading to a recession. Section 6. Stay informed, stay ahead. The value of financial literacy. In today's complex and ever-changing economic landscape, financial literacy is not merely an option, it is an imperative. Understanding the dynamics of federal interest rates, their impact on the economy, and how they influence your personal finances is essential for making informed decisions. Just as a captain must navigate treacherous waters with precision, you too must chart a course through the economic seas. By arming yourself with knowledge, you can anticipate changes, mitigate risks, and capitalize on opportunities. Whether you are planning for retirement, saving for a down payment on a home, or simply trying to make ends meet, understanding the interplay of interest rates and the economy is paramount. Section 7. Charting the course. The future of interest rates. Predicting the future of interest rates is a bit like predicting the weather. There are many variables at play, and even the most sophisticated models can be wrong. However, by analysing historical trends, economic indicators, and the Fed's own statements, we can gain some insight into what the future might hold. Some economists believe that the Fed's aggressive rate hikes will eventually tame inflation, allowing for a return to lower rates in the coming years. Others caution that inflation may prove stickier than anticipated, forcing the Fed to keep rates higher for longer. The global economic outlook, geopolitical events, and unforeseen shocks can all impact the trajectory of interest rates. It is a dynamic and evolving landscape that requires constant monitoring and analysis. Section 8. The power of perspective. Historical interest rate cycles. To truly appreciate the significance of current interest rate trends, it's helpful to step back and examine historical cycles. Over the past few decades, the US has experienced periods of both high and low interest rates, each with its own unique set of economic consequences. In the 1980s, for example, the Fed, under Chairman Paul Volcker, raised interest rates dramatically to combat runaway inflation. While this move triggered a recession, it ultimately laid the foundation for a period of sustained economic growth. More recently, following the 2008 financial crisis, the Fed kept interest rates near zero for an extended period to stimulate the economy. This unprecedented policy move helped avert a deeper recession, but also contributed to asset bubbles and rising inequality. Section 9. Your role in the economic narrative. While the Federal Reserve may seem like a distant entity, its decisions have a profound impact on our daily lives. From the loans we take out to the investments we make, interest rates shape our financial well-being. But here's the empowering truth. You are not merely a passive bystander in this economic drama. By staying informed, making sound financial decisions, and advocating for policies that promote economic stability, you can play an active role in shaping a more prosperous future. Support businesses that align with your values. Vote for leaders who prioritize sustainable economic growth. Educate yourself and others about the importance of financial literacy. Every action, no matter how small, contributes to the collective economic narrative. Section 10. Beyond the numbers, the human impact of interest rates. It's easy to get caught up in the technicalities of interest rates, charts, and economic indicators, but at the heart of it all lies a fundamental truth. Economics is about people. Rising interest rates can mean the difference between owning a home and renting, pursuing higher education or delaying dreams, starting a business or remaining stuck. The decisions made by policymakers ripple outward, impacting the lives of millions. By understanding the human impact of interest rates, we gain a deeper appreciation for the importance of sound economic policies. Let us strive for an economy that works for everyone, where opportunities are abundant, and the pursuit of financial well-being is not a distant dream, but an attainable reality.